So the first time I'm going to talk a bit about the U.S. economic outlook. We'll then spend a little time on each of the major property types from a fundamental perspective. And then last, we'll talk about the investment environment. By the investment environment, I mainly mean what do rising interest rates mean for real estate valuations in the United States, and certainly there are many applications of what I'll talk about there to Mexico and investing in the world abroad. So, the economic outlook. So, first off, if we look at all the real-time data today, things are good. The labor market is extraordinarily hot. We're adding new jobs every month at well above the long-term average pace. We have unemployment rates that have more or less retraced all the way back to where they were in the pre-pandemic. We have prime labor force participation, which is 25 to 54-year-olds who are in the workforce, and that's recovering as well. Everything seems to be on a good track. We have industrial production, when we talk to purchasing managers and manufacturing and services, they're all saying that their businesses are doing very well. And, when we talk about pandemic-related issues, we have on this top left, we have the back to normal index, and that's a mix of things around the economy, but also how many people are going to restaurants, how many people are flying in planes. All of these things have recovered dramatically. So right now, things are very good. There are storm clouds on the horizon when we go look at things like I mentioned, these purchasing managers indices. If we look at their new orders indices, they're still growing, but they've broken down substantially. And so they're right at that level between growth and contraction. You'll see some more data on this, but we also see some storm clouds in terms of consumer confidence, how well they feel about their present economic situation and what their expectations for the future. And expectations have real implications for spending decisions. So, and you can see kind of a combination of all these things in the lower left panel, which is the Conference Board's leading economic indicators. So you can see it's still positive, it's still pointing to growth, but there's been a significant slowing over the last 6 months. And under the weight of policy, our expectations is that we'll continue to see slowing in the coming quarters. So this is not just a US phenomenon. This is happening globally. You can see on the right-hand chart, and these aren't even the latest forecasts necessarily, but growth is going to decelerate this year and next year, all across the globe. Forecasts from every economic unit, every economist in the world basically, has significantly downrated their growth expectations and upgraded their inflation expectations for this year, next year, and the following. So, to put this in context though, of course, you still have a consensus estimate for 2022 of 3.2%. The US economy shouldn't really sustainably be growing faster than about 1.8%. So 3.2% is still a pretty gosh darn good year. The 2023 estimate is still 2.4%. Now, I got to be honest with you. I think some of this stuff is pretty Goldilocks. It's pretty optimistic. But still points is that there are scenarios where we continue to have pretty good growth over the near term. So as I mentioned earlier, what's under the backbone of this is that the labor market is extremely tight. So on the left-hand side, I know it's a lot to take in right here, but the upshot of that is that we almost have as many jobs today as we did before the pandemic. Unemployment and underemployment, which is a little bit more of an expansive definition, are all back to where they were. On the right-hand side, and this is, I think, an even more compelling picture, we actually have about 1.7 unfilled jobs for every person who's unemployed in the United States today. I can only think of one country in the world that's ever had that problem before, and that's Japan before the pandemic. Which was, has and has continued to go through a demographic crisis underlying that. So this is a really unusual state of affairs. And I think part of why the Federal Reserve has been becoming more aggressive is because they've been adding more weight to this. This is being a true indication that even though there's still a lot of workers potentially on the sidelines, because our labor force participation isn't as high as it was, that this is actually the true indication, combined with very strong wage growth that we're seeing, at least in nominal terms. And we'll say a little bit more about that here. That's troubling. There's a blank there, so I'm gonna draw you a picture. What should be there is a plot of household assets, household debt, and then, in particular their cash, and then household net debt. In the last quarter, U.S. household net debt turned negative for the first time since 1987. So in other words, household balance sheets in the United States are in the best shape they've been in decades. And that provides a certain macroeconomic cushion in bad times, and in good times can support spending. And boy, have Americans been spending a lot of money recently. Hopefully a lot of it, some of it ending up here. And so we could see on the right-hand side, though, so left-hand side, very, very positive. And, that backdrop remains. But we've seen a very significant breakdown in consumer confidence. And the reasons for this are pretty clear. The reason is inflation. So you can actually see that in confidence today, when we look at the surveys, is actually about as bad as it was during the initial pandemic, which I find that a little bit hard to believe. So even if we discount that, it still shows that households are worried. And that even though their finances are very good and their wages are growing, we should expect them to start spending less. Even if there weren't the supply chain issues which make it hard to buy some of the things that you might want to buy. So this leads nicely into our next topic. So we have supply chains that are seeing more stress than they have since the 1970s. And this is happening around the globe. And I'll give you a little bit of a hint about what some of the stuff that Enrique is going to talk about. But supply chain stresses, particularly to the extent that they're being transmitted from Asia to the US and Europe, is a very positive long-term indication for Mexico. If you want, there's a lot of talk about reshoring manufacturing and supply chains into the US. That's not where they're going to reshore. They're going to reshore here, which offers secure land routes, attractive productivity adjusted cost of labor, and security of execution. And, no zero COVID lockdowns like we have in China. So I'm very bullish both on Mexico and in particular the U.S.-Mexico relationship. So, to sum up these last few slides, we have households that are spending even though they're probably going to slow down a bit. They have a ton of money. We have extremely tight labor markets. We have fast-growing wages. And we have supply chains that just can't keep up. So it's not surprising to see that we're having inflation. And my colleague, Rebecca Rocky, did a great breakdown of this. So we have a couple different factors. So in the light blue, we have aspects of inflation that are directly related to supply constraints. You can see that's a lot of it. That's about a third of the total. The next is reopening. You might have seen lots of news stories about how, inflation's transitory because it's just reopening sectors. It's the nail salons coming back open. Not really. That's actually been a pretty small aspect of that. The next color is energy. So you're going to have a lot of energy-based inflation when you go from oil at $20 and it goes to $100. And, mind you, a lot of that was already happening even before the events in the Ukraine. That just exacerbated these issues. So, a lot of what we're seeing at the headline level is energy inflation that isn't likely to necessarily repeat itself. I don't think oil's going to 200. And I certainly hope it doesn't. And the next is food, and then finally rent. And rent in the U.S. is a lagging indicator. So that's going to continue to boost. Home prices are to the moon, and that takes about a year or two to fully be priced into CPI. So inflation's not going anywhere soon. And a lot of it is related to energy, and a lot of it's related to the supply chain difficulties, which similarly we believe that they'll resolve. Everything we know about supply chain stress suggests that they do tend to resolve, and they also tend to overcorrect. So you'll have periods of stress, prices go high, they add supply, it overcorrects, then you end back up in the middle again. But with global supply chains, which are far more complicated than they were in the 70s, involve far more components from far more places, and are therefore subject to far greater macroeconomic risks than they ever have been before. And then you nail them with multiple black swans, whether it was that ship getting stuck in the Suez, the initial pandemic shock, the extremely fast recovery from that shock, which threw everything willy-nilly. I mean, you look at auto parts. Part of the issue with auto shortages is that everybody thought we were going to be in this horrible recession for a long time, and they cancel all the chip orders. Well, they canceled chip orders. That capacity got taken up in other applications, and now they can't get the chips when they have more vehicle demand than they were expecting. So this is just a micro case of the bullwhip effect that's been affecting supply chains, and means that they're taking longer to resolve than most people thought initially. And that's part of what's driving this for us from transitory inflation to much more sustained, and then being exacerbated by still more shocks. The market's only really started to get wise this last 2 weeks, but for a month or so, I mean, there have been more ships loitering outside of Shanghai than there were in 2020. And the downstream effects of that are going to be with us for months and months to come. So if we get into our forecast, and this one we get from Moody's, it's very high inflation, very much elevated, that will take a couple years to get us back to target. And I'm not going to be coy with you. If you go do like a private bar room survey of economists, they're going to tell you that the chance of a recession next year are over 50%. And that's my view as well. I mean, I've been constantly updating it. So that's the bad news. I mean, the bad news is that that's generally what it takes to get inflation from 8% back down again. Could Powell pull it off? Totally. It's entirely possible. Lots of things are possible. It shouldn't be our case. That's not what history suggests. The good news is that, like we saw, households are in really good shape. Corporates, while there's a lot of debt in that sector, they've generally termed out. So if we look at corporate bonds, the average maturity is a little over 8 years. So they have some wherewithal. That doesn't mean that there won't be liquidity constraints. All their revolvers are suddenly going to become far less attractive as a backdrop for liquidity. And I would expect to see CapEx coming back in, a lot of pullback in those sectors. But we do not have the makings of a corporate debt crisis. And while the United States government might have some debt sustainability issues in the long run, I'm not worried about it over the next 12 to 24 months. So in other words, we have the recipe for a mild recession, which can hopefully then prepare the ground for a return to a lower, more stable inflation environment, which is also consistent with not 1% 10-year treasuries. That was always a potential, but settling back down into the mid to or potentially low twos at early parts of the recovery. So I think that if you're trying to think about what's a reasonable outlook for the future, that is a very reasonable baseline to be doing your business and investment planning off of. And I'm probably gonna have to move a little bit quicker through these fundamentals because I loitered there a bit. So the first thing we'll talk about is offices. So first thing is just to acknowledge this has been a very bad office market the last 6 or 7 quarters. We've seen more square footage and more percent of inventory in negative net absorption since the start of the pandemic than in either of the other recent down cycles for which we have data. The good news is that people are coming back to the office. So we can see since the Omicron shock, that's that sharp decline just in December, we've seen a very strong recovery. We're still far off from 100% pre-pandemic, and we'll probably never get there. But we're on the course to reach 70% on average across a lot of these markets. There's a ton of differentiation. I mean, Austin's already at about 60% based on this data. New York and San Francisco have had a rougher run, with a lot of other markets in between. So there's going to be regional variation. It's going to have a lot of influences by the geography, the culture, the occupation and industry mixes. But the point is that directionally things are improving. And even looking beyond that, at the end of the day, what causes recovery in the office market is jobs. And whether we go into a mild recession next year or not, the long-term outlook for job growth, particularly of an office-using type in the U.S., is very strong. And that ultimately will get us back to the levels of occupied space that we had before the pandemic. It's not the same as the occupied space that we would have expected without a pandemic. So there is an effect, certainly. And we also think that the distribution of that occupied space is going to be different. It's going to be much more concentrated in the more interactive, more amenity-rich submarkets and the higher quality buildings, because offices of today and in the future are going to be heavily geared towards interaction and relationship building. They're not going to be a play like my classic case is like, I don't expect there to be a ton of call center buildings in 2030. It doesn't make any sense. And so I think that we're going to look at a lot of the traditional value office users are going to have huge penetration rates from hybrid or fully remote relative to more relationship-oriented businesses like ours. And so I think that that's something that we very much have to incorporate into any office strategy going forward. And to say a little bit more about jobs, we also know where a lot of the jobs are going to be. So those dark blue, those are all Sun Belt markets. That's where the most job growth has been over the last 10 years, and it's where we believe the most job growth will be over the next 10 years, both from a total jobs perspective and an office-using employment perspective. And these are significant percentages and numbers of jobs. So if you're trying to line your thesis up with where are the backdrop of fundamentals best for recovering office occupancy, it's very much going to be in these Sun Belt markets, with the sole caveat that a lot of these guys are building very aggressively. So like if we look at Nashville and Austin, they have under construction today on the order of 5 to 10% of inventory. And they need it. Like if you go to those cities, you can look around and you can see the future of the city needs more building for its long-term health to become the cities that they have the potential to grow into be. But that often probably means that there's going to be some softer rent growth in the interim. But that's the price of a better long-term future for those markets, which is ultimately wedded in quality of life, cost of living, climate, and a pro-business environment. So putting that all together, our vacancy forecasts call for them to peak sometime this year, and then it's going to be a multi-year run down. And obviously a recession would extend that timeline somewhat, but we think that we'll get back to more favorable vacancies by the middle of the decade. Interestingly, we also think that suburban properties that have been outperforming in recent years and through the pandemic are going to continue to outperform, in part because they just have a lot less development coming in to compete with. Now, I'd be careful to say that I don't think this is true of commodity suburban office down the turnpike. I think that's heavily at risk, and even before the pandemic, on the investment side, we saw fairly weak bid sheets for some of those properties. I think the natural owners of a lot of the commodity product is going to end up being kind of family wealth that are mainly looking at as an income instrument that they kind of run down to residual value. institutional capital is going to be heavily concentrated in these better amenitized buildings that we've been talking about. So multifamily is a related story, except that really what the positive backdrop is driven by the fact that we've had a fair amount of population growth over the last 10 years. That's those kind of lighter blue bars. And we haven't had a lot of housing construction. Those are the dark blue bars. And then the shaded part shows you the gap between those two. Now, the thing is that like we're starting to build more. You'll see lots of news stories about how permitting is way up, both on the single family side and on the multi side. But you can't, in a couple of years, make up a 10-year deficit that you accumulated. So our expectation is that housing shortages will remain an acute issue, particularly in a lot of the markets that we tend to invest in, for the foreseeable future. And they're only going to be exacerbated by above average levels of household formation that we also forecast over the next few years. The result of which is that you can see there was a very sharp decline in vacancies last year. There's no real cognate for what we saw in the multifamily market last year. Ditto, if we're talking about the kinds of rent growths that you saw in markets like Phoenix, 15-20% year over year increases. So we believe with this pipeline that vacancy will rise somewhat, but is going to remain well below the long-term average, and that this in turn is going to contribute to not 12-20% rent growth like we saw last year, but very healthy in anywhere from the 3 to 6 range, which is very healthy for U.S. multifamily investment and a very positive backdrop. And if there's anything that's happening in the interest rate environment today that is beneficial for multifamily, it's that it's become much cheaper to rent compared to ownership as a result of the move in mortgage rates. So 6 months ago, a 30-year mortgage cost 2.8%. Now it costs 5.5%, which objectively is still a pretty good rate historically, but a doubling of your mortgage payment potentially is not so great. And so you can see where the dividing line is between cheaper to rent, cheaper to own. This is where it was in 2021. So every market that just got absorbed into the cheaper to rent line, we would expect this to be a benefit, to translate into less exit into home ownership, more demand, which can at least partially offset some of the negative factors that I'm going to talk about in a minute that arise from the interest rate environment. So finally, industrial, and I'll go quick through this because here's the deal with industrial. The fundamentals are phenomenal everywhere for everything. You would have to go on, we have a team that's trying to find weakness in the industrial market just to see if there's something that's undervalued or something. It's just they're having a very hard time of it because everything has been doing extremely well. Why? Because e-commerce, we had basically 3 years of e-commerce expansion in 1 year, partial pullback, but still on track. Consumers bought far less services and far more goods, which are much more related to e-commerce and industrial supply chains and drove demands for space. You had supply chain difficulties that made everybody think that they needed a higher inventory to sales ratio, which they haven't been able to achieve, but has helped driven siting decisions and about what they need. And the result has just been this incredible demand, resulting in vacancies which nationally are around 4%, with probably a dozen markets with vacancies under 2%. Speaking with a gentleman earlier today who was telling me that Tijuana has a vacancy of 0%. So that's the kind of industrial market. We could go through a recession and it would mean almost nothing to the industrial market from a fundamental perspective. And to reify that, we have up case, down case, base case scenarios. All of them are good. Our down case is good. There's very little that could disrupt the industrial momentum that we have today. And finally, retail. So we talked about how consumers have been spending, very, very aggressively. Not all of that has gone into e-commerce. 80% of it is in good old traditional brick and mortar. And so, we had a retail sector that was already going through a period of transformation since around 2015. And so we were already kind of getting rid of weak tenancies. And then the fire of the pandemic came through and burned out a whole slew of weak tenancies. And so now we have a lot of, or at least we still have a haves and have-nots industrial market, but the haves are in very good shape. They're leasing up, they're driving rents, they're having positive net absorption. And I think only within the last probably 3 or 4 months have we been seeing more investors realize that this positive story has momentum in the retail sector and are starting to incorporate this into their capital allocation plans. And you should too. So, we can see that, and one manifestation of this is that retail foot traffic is more or less back to normal. As you can see, like I just mentioned, we have positive absorption. Still actually not, particularly troublesome, vacancy rates, even at the national level. And this is looking mostly at strip centers, not talking about ghost malls. And because of the pressure on the retail sector, there's been very little new development. So the supply pressure is almost non-existent. And so there's definitely regional variation. I mean, San Francisco's had a much harder time with a lot of its, kind of floor level retail. Whereas you have a lot of these Sunbelt markets we've been talking about who've actually had declines in vacancies over the last 2 years rather, which is a bit more dramatic. So finally we get to the investment market. And I'm going to have to move quick. So first off, liquidity has been incredible. I mean, last year, we had, this scales off, actually. I'm not sure why, but this makes it look like 2021 was a little bit better than 2019. Now, there were $800 billion in sales last year in the U.S., of which around $300 billion were just multifamily alone, which is also roughly a doubling from 2019. And even, if we're looking at office, it was only off around... So let's see, we have 2021, we have the 2017-2019 average. So you can see apartments up 99%, industrial 83%, office off only 3%, up 11% for suburban, retail up, hotels up. And on the right-hand side, we're looking at a bit more what's happened so far this year. Our prediction at the beginning of the year is that there'd be a rotation back into office and retail. And lo and behold, the share of transaction activity for office, retail, and hotel all shot up in the first quarter. And I expect this to be a theme through the year. One of the, I think, like a micro foundation thing about this is that when the pandemic hit, everyone was just like, no, in 2020, they're like, the only thing I want to buy is industrial. So everybody looks at their asset allocation and they say, I need 5 to 10% more industrial in my portfolio. That doesn't mean that you buy 5 to 10% more industrial over the next 2 years. It means 70% of your acquisitions need to be in that in order to help you get to target. But that's happened to a significant extent. And now the acquisitions profile of investors is going to be closer to their long-term averages. So just mathematically, that means that we should see a rotation back. But even more so to the extent that there are some positive stories that, like we were talking about in office and retail, that suggest that their actual investment merits are improving as well. So I stated this question in the beginning. So what do rising rates mean for CRE values? In summary, it means that values should go down. I'll just tell you, you go and you run your DCF. We all have Argus and things like that. Your model will probably tell you that a lot of values should be off 30%. I'm not saying they're off 30%, but they're definitely not flat. There have not been enough offsetting developments to achieve that. So first point I'll make, is that you can't just look at interest rates. If we just look at interest rates, we can see that the changes in cap rates and changes in interest rates have historically been completely uncorrelated. They don't tell you anything definitive. I know, it sounds crazy. So we need to have a little bit more of an involved mental model, and this is how I think about it. Cap rates are in equilibrium between where interest rates are, where risk aversion is, which we can think of as spreads, or other indicators of risk tolerance across not just real estate, but the broader financial markets. The supply of capital, how much capital demand is there that needs to deploy? So particularly high velocity capital, like we have at private equity funds. And then NOI growth. And by NOI growth, I mean mostly over the next 2 to 3 years. Because like we were talking about with industrial, your NOI growth trajectory at the property level or even at the sector level can meaningfully depart from the overall economy for short periods of time based on local fundamentals. So you need to explicitly price that into your model. So what has happened? Interest rates have gotten, vastly higher. And this isn't even all the way updated. All of this curve should be up. So treasuries are actually up since the beginning of the year about 150 basis points. All of that has flowed through into other risk assets, whether you're AAA, BBB, BB bonds. BBB bonds, mind you, are the most directly correlated with low leverage financing costs for commercial real estate. Usually, like life insurance, like they're lending for low leverage fixed, it's about 15 basis points above the BBB rate. Well, not only have we had base rates increase, but risk aversion in the form of spreads has also increased. Not alarmingly so, but it certainly hasn't moved in the opposite direction, which is what we might have expected in a more quote unquote benign rate rising cycle, where rates are rising because growth expectations are better. Risk is coming down. This is the opposite. We have rising risk and we have rising rates. And so if there's a magnification effect. So if we go back to our mental model, that means that interest rates are pressing up on cap rates, down on values. Risk aversion also is coming in and pointing in the same direction. So if we want respite from these forces, we're all left to this left side. So, the good news on that to extent is that there is a tremendous amount of money out there. So just looking at closed-end funds targeting North American properties. There was around $248 billion in April 22, increases across every major strategy type. So this is a record by a significant margin, and like I mentioned, this is money that has to deploy generally within 2 to 3 years of having been raised. Otherwise, your IRRs are... I'm sure you guys all know more about those pressures than I do. But the point is that even though we have a lot of macro factors that are pressing down on values, you can have some pushback from just the need to deploy capital. The next side of it is NOI. And what I'll say about NOI is we talked about, NOI is very, very good for industrial, very, very good for multifamily, and on a, at least sentiment-wise, an upward trajectory for office and retail. The problem is that we haven't seen that significant of a change in the outlook since the 10-year treasury was at 1.5 to counterbalance it. It's not about the absolute level, it's about has that moved to compensate. So I think there's some of that in retail and office, but we've just had stable yet very, very good outlooks for NOI growth on the multifamily and the industrial side. So I put together a model where the idea was I wanted to bring as many of these factors together as possible. And Enrique, I'm really sorry because I've blown past my time, so I'm gonna move quick here. What I did was I said, okay, I'm going to take cap rates over the last 20 years. I'm going to calculate them pro forma for 2 years of NOI growth. So I used historical NOI growth because that's this idea. It's are you buying a 3 cap or are you really buying a 4 cap in 2 years? It's a very real consideration with a lot of industrial properties. And then I looked at that pro forma cap rate as a spread to the cost of financing. And here's the distribution. Here's what we can see. So those lighter blue bars, that shows you kind of the general trading range, where they usually are. So on the office side, the red dot's where we were in Q4. You're getting a lot of risk compensation. Office looked absolutely cheap. Just part of why it was part of the rotation strategy. Now, and this is pro forma for 100 basis points, like I said, it's been closer to 150. You're a little bit above the long-term average, or more realistically, a little bit below, but not super extended. This should provide at least a little bit of cushion against that pressure from a valuation standpoint. On the multifamily and industrial side, before the pandemic, we had, on the apartment side, a little bit above average. Now, almost certainly either zero or below zero risk compensation versus the debt. On the industrial side, you're almost certainly strongly negative at this point. Particularly, this is for prime properties. And on retail, you're still getting compensated for taking risk. So my base case is that everything should feel pressure. And anecdotally, we're seeing that across our platform. Like, it's happening. Bid sheets are thinning out. We have a bifurcation of buyers and sellers, some who are just kind of hunkering down to wait till the next rate declining cycle if they can, and others who are trying to get today's pricing as fast as they can. And then there's some folks who are in between. But it doesn't matter what product type I'm talking to, we're seeing it. It's most acute on the multifamily and the industrial side, very much consistent with this model. So, my advice here is that be very careful about your underwriting in this environment. And alternatively, I do think that there are reasons to, and I know some of the brokers are going to kill me on this, but this is a time where there are advantages to waiting if you can. Or alternatively, moving very, very quickly, because the debt market's fully repriced. The equity market hasn't quite yet. And again, just be conservative and probably put a little bit higher weighting to your downside scenarios when you're underwriting your properties and your investments.